Okay, and now for the big interview of the morning, actually, the big man from the housing finance space is with us. Keki Mistry, Vice Chairman and CEO, HDFC, joins us. Mr. Mistry, thank you very much, sir, for joining us. Well, you have just raised money at an attractive 8.2% for a 3-year bond. Can we say normalcy has returned to the corporate bond market?
I think things have become a lot better from a monetary perspective compared to what, let's say, 3 or 4 weeks ago. It's not as good as it used to be, let's say, 7 or 8 months ago, but clearly cost of funding has come off. If you look at, we did a 3-year masala bond recently, not a very large amount, 1,000 crores, and that was done at a monthly rate. So there is a monthly rate. The monthly rate, if you convert that, because a year 9%.
Is it still a trust deficit with some players? I mean, barring the big guys like you and, the Bajajes of the world, is there still a...
If you really go back, take on what happened during the NBFC crisis, to my mind, it all started about 4 or 5 years ago when there was so much euphoria about India that everyone wanted to start businesses, start NBFCs. And in that process, a lot of people did start NBFCs and housing finance companies, and these companies went for very aggressive growth. Growth rates of 40 and 50% were common, and anyone who grew at less than 35 or 40% was considered to be a laggard. So we were in that kind of a market. Not only was the growth very strong, a lot of these companies went for an ALM mismatch, borrowing short-term money, lending long-term money, and then because there was so much of liquidity in the system right through 2014 and 17, even though it borrowed money for a short term, it kept getting rolled over from time to time, so it effectively became long-term money. In 2018, things changed. One, because the Fed started tightening, then came rise in oil prices and some degree of inflationary effect, RBI tightening, and the last but the least was the IL&FS crisis. And then there was a complete deficit of trust, as you said. And that continued for a while. And as you know, many of the NBFCs and housing finance companies have been selling their assets to raise liquidity, and they've used that liquidity to pay off their liabilities. And therefore, there has been no default in the system. And my sense is that all the NBFCs and housing finance companies which had this issue in the past have raised sufficient money now to ensure that whatever liabilities come up for maturity over the next 1-2 months, they will have the liquidity to be able to pay it off. So I don't expect there to be a crisis. There is still a little bit of, I would say, I won't say nervousness, but a little bit of skepticism in the bond market for some of the not so well known names. But by and large, I think the significant trust deficit that existed in September, I would say 80-90% of that is over.
That's good to hear, sir. What about real estate sector, though? Is the demand for homes picking up? Is that fear of some big default out of the way?
Demand for homes, to be very honest with you, has never really slowed down. If you look at the growth of housing loans in the banking system, it's been between 15 and 17% now for a very, very long period of time. And that clearly reflects the fact that there is demand for housing. House prices have not really gone up. House prices, if anything, have come down or have remained where they were. So therefore, the growth that you are seeing is actual growth in numbers, in volume, not just growth because the average loan size has got higher. So growth is very much there. The reason you see so much of supply, the reason you see so much of inventory in the market is largely because of the supply. The supply is huge. 20 years ago, if I wanted to buy a property, let's say in Mumbai, I had very limited choices of projects which I could choose from. You probably had 2 or 3 projects that you liked, and you were therefore under that much pressure to take a decision quickly and buy a house. Today, if you go to look for a house, you have 15, 20, 30, 40 such projects. So the choice before you is so large that you are not under any pressure to take a decision immediately, and that, I think, is the key issue. But having said that, demand for housing continues to remain strong. It is just that the supply is so large that it is distributed across a much larger quantum of builders, and therefore you see this degree of unsold properties in the market.
Okay, Mr. Mistry, in all likelihood, there will be a rate cut from the RBI on the 4th of April. But will the cost of money for borrowers fall? Will EMIs fall?
My sense is that RBI will cut rates. But I think as far as the banking system is concerned, the banking system will have to grapple with the fact that their deposit growth has been lagging loan growth. And I think that is a big worry for the banking system. And because the deposit growth has been lagging, they are not in a position or may not be in a position to lower the deposit rates. And deposits, as you know, constitutes a very significant portion of the total funds of a bank. So progressively over the next couple of months, I expect the deposit growth also to start picking up as more liquidity enters the system. February, March typically are months when liquidity tends to be tight because of, one, advanced tax payments, two, because the government's fiscal year is April to March, and therefore a very large part of the government expenditure takes place in the first 9-10 months, and therefore government spending in February, March slows down. And the third reason is tax benefits associated with manufacturing companies installing a plant and machinery or a factory before 31st March and claiming 6 months depreciation. So demand for money is at its peak in February, March. Availability of money is relatively low, which causes this liquidity issue, deposit constraint in the banking system, and so on and so forth. But my sense is, as we move into April, the latter part of April and May, bank funding will also become easier. Deposit rates, it may be possible for them to lower rates, and that could perhaps be the time when you could see across-the-board reduction in rates.
Yeah, and maybe even more rate cuts from Reserve Bank. So this is the last day of the quarter. You can give us some idea of how loan growth and margins did this quarter?
We can't get into numbers because we are, as you know, in the middle of a quarter, even towards the end of the quarter, and this would all be price-sensitive information.
But can you give a broad qualitative statement? Was loan growth better in Q4 than in Q3? Were margins better in Q4 than Q3?
Well, I can't get, as I said, into numbers for the quarter, which is not in public domain. But generally, the demand for housing, I mentioned to you, has been growing consistently at 15 to 17% in the system.
Okay, so 15 to 17% growth in demand for housing. But do you see any pain in your loan against property portfolio?
We don't do LAP loans, as you know, or very limited number of LAP loans. So therefore, there is no, to my mind, impact. And there's no particular impact we see in terms of what you call stressed loans or whatever, nothing like that.
Okay, but is the real estate borrower any better than he was, say, last quarter, or she was?
My sense is this quarter is not going to be very different from what it was in the last quarter, for the reasons that I mentioned earlier, which is the oversupply in the market, the fact that people have been deferring the decision to buy houses because of GST. But having said that, let me also say that I would be fairly optimistic in saying that the quarter starting April would be a lot better, for two reasons. The first reason would be the reduction in the GST rate from 12 to 5%, which would result in a lot of people who had deferred the decision to buy a house coming forward in April and April, May, and buying a house. So therefore, the demand would go higher, the sales would go higher, the cash flows for developers would improve. And the other would be that historically we have seen that after elections, assuming we get a strong, stable government at the center, which I have no doubt we will, then that by itself will result in a positive impact on the entire economy, particularly for the housing sector. We've seen that in 2009, we saw that in 2014.
Okay. Well, Mr. Mistry, I didn't mean to ask you for things that you should not say. The only reason why I asked you about your Q4 loan growth was that we know a lot of NBFCs are not able to repeat that 40%, 30% growth. So I just want to know if your market share has grown. Have some of the borrowers who went to those NBFCs now coming to you?
Let me put it this way, that for the quarter and for the month of March, we don't have data of what everybody else has done. We don't have data, for that matter, for February either. So it's based on conjecture. Yes, my sense is we would have got a little bit of market share, but you must also recognize that a lot of these loans which typically are done by these NBFCs are not the kind of loans that HDFC generally would do. and therefore a small portion of the loans that these people used to do, we would do. So to that extent, yes, we would have got a little bit of market share.
Okay, Mr. Mistry, always a pleasure speaking with you. Thank you so much for joining us and talking about the fact that some of the liquidity crisis has ebbed. Things are getting back to normalcy. In fact, there's a 15 to 17% growth in demand in the housing industry. Let's take a quick break on that note. But up next, we'll continue with this focus on demand trends. We'll shift gears to the consumer space. We have Anjan Chatterjee, the Chairman and Managing Director of Specialty Restaurants, and consumer economy expert Rama Bijapurkar. Stay tuned.